Welcome to the lecture for part 1 of chapter 1. So chapter 1 gives us a broad overview or an introduction to accounting. So I'll talk a little bit about that. In this lecture, I'll go through learning objectives 1-5, where we talk about business events. And then in the second part of the lecture for chapter 1, I'll cover the financial statements. So learning objectives 1-6 through 1-10. And the way financial statements interact with each other. So first of all, big picture here. So accounting, in this class, we'll be studying financial accounting. So that's what you study in Accounting 201. Financial accounting is based on how we report financial results to outsiders. So owners of the company, creditors, that sort of thing. It's very rules-based so that there's comparability between companies, separate companies, and comparability over time. And it's all based on what we call generally accepted accounting principles, or GAAP. So that's what we'll be studying in this class. Cost accounting, which is something that you'll cover in Accounting 202, deals with determining what the cost of either products that we manufacture or services that we provide, what those costs are. And of course, that's fairly complicated. It's more of an internal thing, so there aren't as many rules associated with it. But it then feeds into managerial accounting, which you'll take, some of you will take in Accounting 353. And that deals with how we use the information from cost accounting to better manage a company, in addition to how to do budgets and forecasting and things like that. So our focus is going to be on financial accounting. So a couple of things to talk about here. So there are different reporting entities. So that's the reporting entity is the organization for which financial records are maintained. So usually that's a company. And we'll talk about different types of companies a little further in the semester. It could also be a division within a company. So sometimes companies are broken down into smaller segments for reporting purposes. And the people that are going to receive the financial statements are what are called stakeholders. So stakeholders are people that have a stake in the outcome of the business. So one example might be an owner. In the case of a corporation, owners are called shareholders. Obviously, what's the question that's on their mind? Am I going to be able to sell this company for more than I paid for it? Am I going to have a gain here? Am I going to receive a portion of the profits? How's the company growing? Are they profitable? That's what they care about the most. Creditors, banks, entities like that loan the company money, what do they care about? They care about, are they going to get paid back? That's their only concern, is are they going to receive money back on the money that they lent the company? Employees have an interest in the case of unions, where they want to negotiate for raises and better benefits with the company, but they know that they can't ask for too much that puts the company in peril. So they have an interest in knowing how the company is doing. And then lastly, suppliers are much like creditors. They're giving credit to the company. They're saying, here, we'll provide you with some raw materials so that you can make your products, and please pay us in 30 days. Well, they should look at the financial statements to have a feel for whether or not the odds are good that they'll get paid in 30 days. So the results of a company financially are communicated through financial statements. And financial statements, there are 4 of them, 4 primary financial statements. The first one is the balance sheet. And the balance sheet indicates what a company owns. So they own things like a building, they own cash in the bank, they own maybe trucks and machinery. They might own some things that you can't see, like patents and trademarks and copyrights. They might own intellectual property. So it's all the things they own, and then the claims on those assets. So who do they owe money to, and what is the owner's claim to the business? What is the owner's investment worth? The income statement shows, so the balance sheet is as of a specific date. So standing on, say, December 31st, at that moment in time, what did we own and what were the claims on those assets? An income statement talks about what happened over a period of time. So it's revenues, which is what we get for providing products to customers or services to customers, less the expenses that are incurred in an effort to generate those revenues over a period of time. That tells us if we had a profit or a loss, if we made money or lost money. The statement of changes in equity is a reconciliation of what the owner's interest in the business was at the beginning of the year and what caused it to increase, like being profitable or making further investments, and what caused it to decrease, losses and taking money out of the business. And then lastly, and we'll cover this in more detail near the end of the semester, are statements of cash flows. So that's where did money come from? So how was cash received in the business, or what ways was cash received in the business, and what was cash spent on in the business. So it reconciles a beginning cash balance to the ending cash balance. And that can be very important. We'll learn later when we talk in I think a next chapter about accruals, that cash flow and income are not the same thing. So we'll talk about that more later. So different elements of the financial statements, as I mentioned a minute ago, assets are the things a business owns. So, and again, those are tangible things that you can touch and see, and they're intangible things like financial assets or intellectual property. Companies also have liabilities. Those are another word for debts. So money that they might owe to their suppliers, money they might owe to their employees for payroll, money they might owe the government for taxes, or money that they might owe a bank, say for a loan that they've taken out. And then there's equity. Equity is the owner's interest in the business, and that consists of contributed capital and then retained earnings, which I don't have listed there. I mentioned earlier, revenue is what we get for providing products to customers. Expenses are what are incurred in an effort to raise those, to create revenues. So expenses might be rent, payroll for your employees, the cost of the product that you're making, if it's a physical product, advertising, all of utilities, all of those kinds of things. Distributions are the way we share the profit of the company with the owners, so sending them a dividend in most cases. Net income is revenue minus expenses. It's another word for profit. And that's distinguished from gains, which occur when we sell an asset. So if I have a used truck in my business and I sell it, selling that may generate a gain or a loss. We keep that separate because it's not really part of what we're in business to do, which is to make our products or provide our services. So the accounting equation, this is a very critical equation that everything else is built upon. So the accounting equation has assets on one side of the equal sign. That's what the company owns. And then on the other side of the equal sign are all the claims on those assets. So the people that have claims on those assets are creditors in the form of liabilities. If I borrow money from a bank has a claim on my assets. If I don't pay them, they can come take some assets and get their money that way. And then the owners of the company have stockholders' equity. That's their claim on the assets. So if we ended the business today, we would turn all of our assets into cash by selling physical assets, and our assets would consist of cash. We would use that cash to pay off our liabilities, and whatever is left over would go to the owners of the company as part of their claim on those assets. So it's a very important equation, and every single business transaction is going to result in that equation remaining balanced. You can never have the equation out of balance. So there's a couple of different ways that we can look at transactions, or ways to categorize them. So one type of transaction is an asset source transaction that increases the total assets and increases the total claims. So both sides of the equal sign go up, okay? So an example would be taking out a loan to buy a truck. So my liabilities go up on the right side of the equal sign. My assets go up on the left side because now I have a truck I didn't have before. We can have an asset exchange transaction. That's where both the increase and the decrease happen on the same side of the equal sign and they offset each other. So one asset goes up and another goes down. An example there might be buying office furniture with cash. So my cash goes down, that's one type of asset. Office furniture goes up by the same amount, that's another type of asset. So my equation stays balanced. I could also have an asset use transaction. That's where assets go down and claims go down. So that loan I took out to buy a truck, if I pay that loan off with cash, my cash balance will go down, which is an asset, and my liability, the loan, will go down. So both sides of the equal sign decrease. So the last category is a claim exchange transaction, which we'll cover more later. But that's where, kind of like an asset exchange transaction where one goes up, one goes down on the left side, this is the same thing on the right side. So one type of claim goes up, another type of claim goes down. That might be, I hire you to do work for me. That incurs an expense which pulls down my stockholders' equity, and I'm going to pay you later for that work, so that increases my debt. So I have debt going up and an expense going up, which brings down my stockholders' equity. So I'm going to walk through some transactions here, and up above the transactions are described in a narrative, and then down below we can see how they're applied to that accounting equation. So I'll talk through each one here. So in the first one, RCS issued common stock, that's shares of ownership, acquiring $120,000 in cash from the owners. So they gave $120,000 worth of stock to stockholders. So under stockholders' equity, common stock, that's a component of stockholders' equity, increases by $120,000 and cash increases by $120,000. So that's an asset source transaction. The next one, RCS borrowed $400,000 in cash. So in that case, I have a liability, note payable, going up, and I have cash going up. So that's another asset source transaction. Number 3, RCS paid $500,000 cash to purchase land. That's an asset exchange transaction. I'm exchanging one type of asset, cash, for another type of asset, land. So cash goes down, land goes up by the same amount. That leaves my equation balanced. Next, RCS received $85,000 cash from earning revenue. When we earn revenue, that increases our stockholders' equity in the form of retained earnings. So retained earnings or stockholders' equity goes up by $85,000 and cash goes up by $85,000. So both sides of the equal sign have gone up. That's an asset source transaction. The next one, RCS paid $50,000 cash for expenses. So that's an asset use transaction. Cash goes down. Well, if revenues pulled up retained earnings, expenses are going to pull them down. So my retained earnings decreases with an expense and cash goes down. So that's an asset use transaction. Both sides go down. Next one here, RCS paid dividends, so we returned some of our profits. You can see if we had revenue of $85,000 and expenses of $50,000, we had net income of $35,000, so the company's elected to share $4,000 of that with the owners. So cash goes down by $4,000 and retained earnings goes down by $4,000. That's not an expense, it's sharing part of our profit. Then the last transaction there, the land that RCS paid $500,000 to purchase had an appraised market value of $525,000 on December 31st of year 1. Well, that's not an economic event. That's not a transaction. No money changed hands. The financial position of the company didn't change. That's just an information only kind of thing. So that doesn't get recorded in our accounting system under that. So you can see NA across the bottom. So hopefully that makes sense to you. I will talk to you again when I lecture on part 2 of this chapter. Thank you.